Welcome back. So the reason for the emergency update lies in this month's indices, where we've had a huge, very statistically significant move in house prices, namely sold prices. So first up, let's jump over and take a look at house prices to assess the latest moves. Here we're using the source of housepricecrash.co.uk, where we track 5 major indices. And let's start with Nationwide, which is showing the first positive month-on-month move since August of last year, but still showing negative year-on-year growth of 2.7%. Next up then is Halifax for the period of April, showing a 0.30% move down and still showing anemically small year-over-year growth at 0.1%. It also shows a divergence from the Nationwide index, which historically it's had a very high correlation with. Now, to explain that, obviously, I can't because I'm not Halifax. However, if I was to offer up something plausible, it would simply be down to lending criteria based on the risk profile of their loan book. Well, meaning what? Well, in each video series, I make an effort to harp a little bit of small print, so you've probably heard me say both Halifax and Nationwide derive the data and therefore their index from their own mortgage lending data. So any divergence probably won't be as people have speculated, which was they wanted to fudge the numbers, but perhaps a divergence or change in that mortgage lending data. So for example, let's say they specifically moved from one demographic and or region to another, pushing say more first-time buyer mortgages who typically buy smaller bedroom properties and or maisonettes and flats, and pulled away from a larger properties typically bought by families of a certain age demographic. So if they focus on lending to a certain type of people who buy certain types of properties, then by rights this will skew the mortgage lending data and then their index. Okay, next up, Rightmove then. The May figures showing asking prices up 1.8%, giving annual change of 1.5%. Now, if that left you scratching your head, you aren't alone. And later in this video, I dedicate a section to a deep dive on this, where we're asking things like, what's the difference between asking prices and actual sold prices? Because you can ask what you like, but it's the sold prices that matters. Also, how does that look historically if we back that data set out? Spoiler alert, it's very, very telling. So somewhere near the end of the video for that, technically it's not a leading indicator. Two left are the Land Registry and the ONS, the Office for National Statistics, and both actually use the same report, i.e. the same data set. So it's 285,000 and change, depending on where you're looking, with the ONS seasonally adjusting their figure month on month, and that figure comes in at 0.9%. Whereas the Land Registry's got the figure non-seasonally adjusted at negative 1.2%. Now, just for clarity's sake, that's a massive move. And I can show you in my spreadsheet here just how big of a move that really is. Here I've isolated the last 20 odd years of data, but just for the month of March. And as you can see, we haven't had a move to the downside this big this century. Plus, that's now the fourth consecutive month-on-month drop in prices, and this index lags. So that's the reason for this emergency update. But we don't care for headlines. We want to know, is there anything at all that could be driving this? Well, I'll show you this. So here we've got price data broken down for England, Northern Ireland, Scotland, Wales, and then again from this row for the regions of England. Now, I don't want to put anybody to sleep, but at minus 4% for a month-on-month move for the West Midlands is absolutely huge. So again, just how big this is made clear in this tab, where you can see I've ranked the last 20 years of monthly data just for the West Midlands, and these are sold prices in order of largest to smallest. And so I better get scrolling, as I know that we're looking for a negative figure. In fact, minus 4% or minus 3.99% is the second largest move in over 20 odd years of data. You can see it highlighted in blue. It's in fact bigger than the crash of 2008. You can see these 2008 months here. Now, unlike, say, how I did with the Halifax index, offering up some sort of explanation, I can't do that here, or there's no need to do that here. This is a sold price index. As the name suggests, these are sold prices. It is what it is. Huge moves then are happening in the UK housing market. Hopefully that's woke everybody back up, but this is a video series about property market leading indicators. These are prices, i.e. this is what's already happened. So what's moving them? Well, let's focus there. So let's kick off with mortgage approvals, a leading indicator of future lending. So for a wider understanding of mortgage approvals and what they mean, I suggest you go back and look at further videos because they hopefully will be explained more there. However, we've got two types of mortgage approvals, or rather we've got two graphs, one overlaid with year over year sold prices, and in this chart here we've got them overlaid with nationwide, which is slightly more timely. So what's the latest reading? Well, it's 52,011, which if we look on the big chart here, you can see slightly better, overlaid again with the nationwide year over year annual change. You can see that we're seeing a slight uptick. Just how much though, I can show you slightly better from this graph here. Is it time to get bullish? Was the property market bottomed actually in January with this reading of 39,000 here? So if we look a bit more closely at this chart from this peak, you can see we have had months of consecutive upward moves. However, this is probably better explained in this graph here. Here we've got the peak in November 2020, subsequently down to where we are with the latest data here. The red bars indicate months on month moves upwards, and you can see we've got 1, 2, 3, 4 periods of this happening. So was the bottom here in January 2023? Well, in fact, this is nothing we haven't seen before. We've seen in April of 21 and May, 2 consecutive months where the move has been positive. We then see a downtrend to November of 21 where we see 1, 2, 3 months of upward movements. We then see a sell-off again with another 2 months in July and August of 2022 before a huge sell-off to where we are now, being Feb and March. So maybe it is the bottom, only a mind reader would know, but it's nothing we haven't seen before, and it's not to be confused with what it could potentially be, which is a bull trap. We're going to now run through and look at our further leading indicators, and that should hopefully provide some colour to why we're seeing this uptick in mortgage approvals and what's likely to happen after that. Average weekly earnings here are real, so adjusted for inflation, are a huge metric at driving growth in the housing market. In fact, it's extremely highly correlated, and I'm not just using hearsay vernacular, it is really highly correlated using Pearson's correlation R. And the graph should be self-explanatory. When we see average real weekly wages moving to the upside, we also see house price growth, real house price growth. When we see it peak and fall, we see a fall in real average house prices. And again, this uptick, we've seen real house price growth. So when we saw it peak out here, this should be on everyone's radar to start pricking your ears. So what's the latest data? Well, in March, we see average weekly real wages of £504. We have had some revisions in this data. We cover this in each video series. So if you're following along intently, you will see the Office for National Statistics has revised this data. So certainly down off top, but we're also interested in this mellowing out. It doesn't appear to be falling as fast because just as important as the actual figures is the rate of change. And so to conclude, a falling in average real weekly wages is bearish for the UK housing market. Of course, wages determine, well, living standard for one, but also the amount of money a bank, building society, or any financial institution would be willing to lend to us, but it also contributes to savings and for something like a deposit. So those savings or that cash flows through and is picked up by M4, the monetary supply. Here we've tracked M4 growth and we've plotted it against house prices. We've two metrics here, we've M4 and we've M4 retail. And in the top graph, we're using real, so inflation adjusted of adjusted house prices here, or percentage growth in house prices here by CPI. And I've done the same for the nationwide index, calling it the real nationwide house price percentage annual change. And for anybody new, I make note of the three same notable points in this graph. This is the 1990 blow up, this was the 2008 blow up, and this is what we're in now. Anytime we've seen significant falls in real M4 growth, we've seen house prices do the same. So this is a fantastic indicator, and that's the reason why we track this. And the figures for this month are both M4 down and M4 retail down. Another bearish indicator or leading indicator for prices in the UK housing market. Moving on then, rates play a huge factor in affordability, and affordability obviously plays a huge factor in pricing. So when we look at mortgage rates for the latest data, and this is from the Bank of England, we can see another sell-off in rates. So falling rates and therefore improved affordability is actually quite bullish for the UK housing market. House price crash averted, right? Well, not so sure.